Welcome to Bitcoin Fixes This, where we explore the impact that Bitcoin will have in all aspects of society. Today's guest is PlanB, financial modeler, Bitcoiner, and traditional investor. We talk about the current market, negative interest rates, and trades like the Bitcoin future cash and carry. PlanB also tells us about why he created the stock-to-flow and stock-to-flow cross-asset models, how he looks at investments, and why eliminating risk also eliminates reward. PlanB is one of the most popular anonymous accounts on Twitter, not just for his thus far accurate predictions of the current bull market. He's got a long history in the markets and has been through the economic upheavals of the last 25 years. His experience in the market and his analysis was really eye-opening. I'm releasing this early to celebrate getting to 200,000 followers on Twitter. To all of you that made it possible, thank you and enjoy. PlanB, how's everything going?
Everything is fine, Jimmy. Thanks for having me.
Yeah, roughly whereabouts are you in the world right now?
I'm in the Netherlands, Amsterdam. It's about 9 o'clock in the evening, and like the rest of the world, we're under lockdown and curfew. So it's darker than usual in Amsterdam.
And how is that for you? Like having curfews and stuff. I don't think I've actually had curfews here in Austin. I can't imagine what that's like over there.
Yeah, that's crazy. Actually, the lockdown is not funny. It's restrictions on how many people can be in your house, and of course, work is all remote. But the curfews are even worse, and they basically don't make really much sense at all. So but you can't leave your house at after 9, or you will be fined. Sometimes beaten up by the cops, and it's really reminds you of the war, and it really is like 70 years ago, 60 years ago in the wartime. That was the last time we had a curfew in the Netherlands. It's crazy.
Oh wow! Yeah. So it's kind of like a war, but against an enemy that you can't see or really feel or anything.
Yeah, almost against your own government. It's very, very strange situation.
Okay. Well, so a lot of people know about your work, but they don't really know like what you do for a living and stuff. So can you sort of sum up for our audience what it is that you do as your day job and why, how that led to the model that everyone looks at now?
Yeah, so I'm an investor. I study economics, financial economics, and law. Actually, I have 2 degrees. And after that, I started working in traditional finance. So I've seen trading rooms, I've seen bank balance sheets, life insurance balance sheets, and currently I'm working for a big Dutch institutional investor in a team that actually invest the balance sheet, and that balance sheet is about $100 billion big. And as you can imagine, those are not the very fancy investments. Those are the mortgages and bonds, all fixed income that generate interest. And but it's very interesting because you always have to deal with central banks and with capital charges that are derived from the volatility of the risk of those investments. And from that perspective, from that position, actually, I have actually witnessed a lot of crises. My first crisis was 1998. The Asian tiger, the foreign exchange markets, and the Russia default, and then the dot-com crisis, of course, and after that, 2008. The banking crisis, the global financial crisis, and now we're in the COVID crisis, and especially things like quantitative easing, and in Europe, negative interest rate policies with interest rates at minus 50 basis points. It's a weird world, even in the traditional finance world. That is very boring. Normally, it's kind of very strange, and from that perspective, Bitcoin is one of the few light points in the darkness.
Mm. All right. So you work in the traditional finance world. I guess like modeling certain securities and trying to figure out the risk of various things. Is that right?
Yeah. So yeah, my main focus and my specialty is modeling so valuing the investments, but also sourcing them. Um, and well, if you buy $1,000 or $1 million even of something, that's not a big problem. But if you source like the minimum amount that we source things in is like hundreds of millions or even a couple of billion, then you have to have a sourcing strategy. And well, the calculation and all the analysis, that's the part I like most. But of course, as that goes in your career, the further you come, they make you a manager, and then you yeah, you have a whole team, and then you manage people as well. But my hobby and my really my specialty is all sorts of magic with cash flows and investments, and also the legal part, right? The SPVs and structured finance, as we call it.
Well, so that brings me to a question. So, how does central banking policy exactly affect traditional finance? Because you seem to place a great importance in what they do and how that's used for your modeling.
Yes. So a normal company has shareholders that they have to they have to take responsibility, they have to account for, shareholders and accountants, but a bank or an insurance company needs to be compliant to the laws and to the regulators like the central banks. They regulate the banking industry. So for every investment that you make, you sort of have to have an okay from your central bank, and they review all your plans yearly. They do audits, and you have to report on a monthly basis about all your investments, the whole balance sheet, and what kind of risks are involved in the investing. But also they translate it then, or the law does that, and they control it. How many capital you have to hold against it. So that's the whole capital management part of investing. And and there's also the asset liability part. So for example, a bank has saving accounts, very short duration liabilities. So they need to have short duration assets against it. And a pension fund, for example, will have very long duration liabilities, the pension liabilities that could take 10 or 20 or 30 years. So it's very natural to put long dated, long maturity investments against those. So that's where a lot of the risk comes from if you don't do the matching well, and they control it. So, and then of course there's the lending facilities. You get you can lend at the central banks. They can. And the rates, the short-term interest rates, are very important. They sort of direct the market. They sort of are the base rate, the market rate, if you will, that is set by the central banks. It's short duration, but nowadays, especially after 2008, they also, when they started QE, quantitative easing, printing money in normal terms, they started buying all sorts of stuff. In the beginning, it was stuff on the balance sheets that was basically in default, or troubled assets, if they as they like to call it. And when they buy stuff like mortgages and bonds, they buy it. The prices go up and the interest rate goes down. So in that way, they also put pressure on the longer term interest rates, like the 10 years or 5 years interest rates, not only on the very short 3 month, 1 month, but their influence is all over. And it's a good thing, because they keep their goal, of course, is to keep the system safe and to keep all the banks and insurance companies solvent, and so that they can honor their liabilities.
Okay. Well, so let's dig into that a little bit because a lot of people know that there's some sort of Fed funds rate, or I think in Europe it's a different rate. Why is that interest rate so important? Like the ability of the central bankers to lower or raise those interest rates is given a lot of importance, but I don't think that many people understand exactly why. So could you explain why that ends up being such an important part of traditional finance?
Yeah, so there's a couple of things to unpack. First of all, the main asset for an institutional investor, a bank or insurance company, is short or is fixed income instrument. So mortgages, everything with a coupon, with an interest rate. So that being the main part, and with the things I said earlier, the influence of a big buyer like a central bank in the market is always important thing to look at. But the main thing that central banks have, what their mandate, if you will, and it's different in the US than in Europe. But in Europe, it's very, very simple. The mandate is to keep inflation rates at 2%. And if the inflation rate gets too high because the economy overheats, it's going very well, they normally raise the interest rates to slow it down and keep the inflation's low, and that's the other way around as well. So if right now the interest rate is going down, and that's also because of old age, population getting older and older, especially in Europe and Japan 20 years earlier. So and technology, of course, those are all very deflation oriented forces. So they really have a problem keeping the interest rate or the inflation rate at 2%, and that's why they are very easy in the money they make available. So they call it easing, quantitative easing. They just print a lot more money because that's good for the economy. The economy will then grow harder. That's the thinking, at least, and then inflation rates will go up again. But until now, we have not seen that. Of course, only in the assets that they are buying, but not in the stuff that we, the normal people, are buying.
Okay, so just to sum up, basically the central bank, if they raise interest rates, that has the effect of having less consumption. But if they lower interest rates, then more investment happens with the extra money printed or something like that, and that's the idea that they're doing. Is that right?
Yes, that's right. Yeah.
Okay. All right. So obviously you've been in traditional finance a long time, and you named for us three different crises that happened, like 1998, the ruble collapse. I think the Asia crisis around then too. And you mentioned 2008. I think there was also post 9/11. There was a bit of a blip there. Why do these things keep happening if these central banks are so focused on keeping the economy stable?
Yeah, that's a very good question. I think it's part of life. I think it's part of life to sometimes make mistakes as investors, especially if the economy is going well, like in the dot-com crisis with the internet bubble. There is a lot of misinvestment, of course, and some people get burned, and that's how it should be, right? It's a part of life, and what they're now actually trying to do, and mainly since 2008, is prevent companies from defaulting, and especially banks, because they are, of course, very important for the economy. But by trying to prevent default in all areas, they're just killing the business cycle, if you will, and eliminating volatility. It's like we can't have any volatility anymore. We can't have defaults anymore. We can't have people losing their money anymore. So it's actually kind of a joke in the market since Ben Bernanke put the interest rates close to zero. we were talking about the Bernanke put. So everything you could buy equity, for example, you could take risk, whatever you wanted, because the central bank would always come there to save you if it would go wrong. And that's what we call the Bernanke put. And that, of course, is not very healthy thinking, because you will take too much risks knowing that the central bank will come and rescue you. And yeah, I like the talk that and the story that Jeff Booth has in this respect with Schumpeter, the economist, with the theory about creative destruction. So creative destruction means that companies have to go bust. They have to go into default and make room for new technology and new companies that and new people as well. And that's a very important ingredient of capitalism, of financial markets as well. So if you take that away, then yeah, you get very strange situation, and that's exactly the situation we're in right now.
Yeah, so just to explain for my audience what a put option is, it's the right to sell you something at a particular price. And what you're saying with a Bernanke put is that any business that you have, you'll always be able to sell it at a certain price because there's going to be a buyer or a lender of last resort that will essentially rescue you should you have a worse business than you thought you did. And that's essentially backstopping the entire economy. So with respect to that sort of thing, which causes this lack of creative destruction that you were talking about, what effect does that have in traditional finance? What sort of how does that change your investment strategy and so on?
Yeah, there's one dominant thing actually. By taking volatility out of the market, volatility being risk, by taking all the risks, by insuring all the risks, if you will, and preventing companies and banks and insurance companies from defaulting, they also take away all the yield, because risk and return are two sides of the same coin. So by preventing all risk, but there is also no yield anymore. So the biggest problem, and that there is right now in finance, is there's no yield. So everybody's looking for return, but there is no return, especially in Europe with the whole yield curve, the interest rates from 1 month to say 30 years, they're all negative. So yeah, you have to take on some really exotic investments to make even a couple of percent return, and that of course also leads to unintended consequences.
Well, so who buys those negative yield bonds? Because you're actually paying them to hold your money. So like, who buys those?
I do. yeah. Well, professionally, then of course, everybody does, because we all know that the interest rates go down, and when the interest rates go down, so you don't make the interest on your investment, so you don't get coupons. Actually, you have to pay. But if the interest rate goes even further down, the actual value of your investment will go up, and that's actually been a very good, very nice investment. So even the negative yielding bonds, as long as the interest rate goes down and keeps going down, there's no problem. But when it stops going down, or even, God forbid, when interest rates go up, then the music stops.
So it's predicated on interest rates going down even more, which causes the value of the bond to go up, even though it's essentially like giving them money to hold it, or giving them money for the privilege of them holding your money or something like that. Because of this expectation that rates will go even lower, the price of the bond goes up, and at least you can make a profit on that. Is that what you're saying?
Yes. Because so for example, if you have a bond that's yielding -1%, and that seems like a pretty bad deal right now. But in a world, say the interest rate goes down again and it goes to minus 5%. And okay, that sounds very outlandish at the moment, but the IMF, of course, has already studies done and implementations ready for a scenario like that. But once you have a situation with a minus 5% interest rate environment, your minus 1% bond is the best thing there is, right? It's better than minus 5. So that goes up in value. Yeah, that's exactly how it works.
But I mean, in a sense, what's being created are all these toxic assets, and no one's going to want as soon as the music stops and soon as they can't drop the rate anymore. That's also what you're saying?
Yeah. So it's all very weird to every one of us. You know, the normal models that you need for valuing these assets stop working, right? Even in Excel, you plug in a negative interest rate, it all starts to get very weird. But yeah, I think we're all aware that it's uncharted territory, and we're all, sort of anxious to see where it ends. But this cannot go on forever. So yeah, I don't want to be a doom's prophet, but this is going to end somewhere.
Yeah. Well, it's interesting what you said, that like risk and reward are two sides of the same coin, and that because the central banks have more or less removed risk, you also get no reward, and that the whole system is basically completely static at this point. Or, I mean, it's leaking a little bit or something like that through these negative rates. What's like, are they looking long term? Like, the central banks have to know that the music's going to have to stop at some point, and that they're essentially creating a world where there's no growth whatsoever.
Yeah, well, they know. They're very transparent about it. So once they started quantitative easing, they said it as well. Like, okay, governments, we can go this path. We can go and finance the whole economy. We can go negative interest rates. We can go quantitative easing routes. But remember, there is no way back. There is no way back. So we can blow it up right now or kick the can. But let's choose that route of kicking the can, because at least we have time to think of something smart. But they know it, and we're just kicking the can right now. So yeah. And it's really worse, Jimmy, because you know, all the markets are of course interconnected. So a fixed income market is connected with the equities market, is connected with the foreign exchange market, it's connected with all the derivatives markets. So if the interest rates go down, people go, like me and my company, but also normal people, they go and looking for yield. Where can you get a return? And that, well, then the first thing you notice is the equity market, of course. So you take your money off your saving account. You put it into equities. But if you look at the equity markets, the dividend yields are, well, historically low. It's very low, and and then what do you look at? It's a very fragile situation, and then something like Bitcoin comes along, which is, well, like the complete opposite of everything that's going on right now, and almost too good to be true. Yeah.
Well, all right. So you're saying all of these are connected. Let's pull on that thread just a little bit. To what degree does the bond market affect, say, the public equities market?
Oh, there's a lot of connections, but there's one connection is for the companies themselves, so they can lend money cheap. If the interest rates are down, they can refinance all their current bonds and loans, and with that money, they can buy back their shares. And buying back their shares means the shares go up in price, and of course that's very good for their options and their bonuses, but also for investors. If the risk return on bonds is not very good anymore because the interest rates are negative, for example, you start looking at other markets, equity markets, for example, and then you start buying them and bidding up the prices as well until those markets are not attractive anymore. So it spills over in that respect. And then there's the derivatives markets as well. An option is basically a call option, for example, is basically a combination of a bond and a stock market position or an underlying. It matters what kind of option it is, but there is a connection through the derivatives markets as well. So yeah, there's all sorts of interconnectiveness between those markets.
Okay. Well, so let's talk about Bitcoin, because what you're saying is that it is just so different than what's out there. Can you describe some of those differences? And as sort of somebody that works in the traditional finance space, what strikes you about it, and what is actually really different?
Yeah, if we just look at it from an investor point of view, so without going into all the technical details or even what it is, just see it as a number on the screen, as some asset I can buy. What you then and investors have a really simple look at the world. They view the world as a risk on the x-axis and return on the y-axis world. So it's a two-dimensional world. It's risk and return, and well, everything is sort of dropping down to the zero risk, zero return bucket or corner, if you will. And then comes Bitcoin. Bitcoin is on average 200% return last 12 years, right? 200%, which is already way above anything else in the market. And the return is 200%. The risk is also very, very high. It's like, well, depending how you look at it, the worst year was like 85% loss if you take that as a risk. And if you look at option markets, you can look at implied volatility. It's 100%. Sometimes it's more. So you have a thing that is very risky, say 80% risk. You can lose 80%. And it's very, very high return, like 200% on average. So it's the total opposite corner of that two-dimensional world. and you can see that as a slide, right? You can take you could put not all your money in Bitcoin. You could put half of your money in Bitcoin, or 10%, or even 1%. But it gets weirder even then, because if you would have put 1% of your money into Bitcoin and 99% into cash, just do nothing with it, that combination would have done better than the S&P 500 in both risk and return terms. So you would have more return and less risk, and that is sort of the holy grail that every investor is looking for. And if you find it, your first reaction of a trained professional investor will be, this can't be true. What did I do wrong? Let's calculate it again. And then you calculate it again and you find it again. So it's really something that shouldn't be there. But still, anyone can buy it. And even, what is the example that is most recognized by traditional investors? It's not the outright, or at least the investors that I talk with, it's not the outright Bitcoin position where you had to have this 200% return and 80% risk. No, it's the futures markets, the cash and carry strategy. So you buy a Bitcoin and then you sell it at the same time for delivery 1 year later. And the futures market is in contango. That's a technical term for the future price of Bitcoin is higher than the current spot price of Bitcoin. And it's about 20% higher. So you earn an immediate 20%. So you buy Bitcoin, you sell it on the futures market for delivery 1 year later, and you make 20% profit in dollar terms. Okay, but you're only interested in dollar terms. And and the risk is there is some risk, but not much, because the position is collateralized, and with margins, it's kept up to date daily. So the risk is really, really low. And actually, I don't understand why not every bank and an insurance company is at least studying it and even, put a toe in the water and trying it with some small test portfolio. It's really, but it's something they recognize and find very interesting, even more interesting than the outright position.
Yeah, that is interesting. That whole contango that has, and you have that cash and carry strategy where you buy the Bitcoin right now and sell the future, and then you just have to carry it to term, and then you deliver the future, and then you're done, and you make 20% in that period of time, which is kind of crazy that that's available and that it isn't getting pounded. Because in a sense, if you're selling the future, then the future price should come down. So why does this gap exist? Is there some risk in there or something that we're not spotting? What's going on?
Yeah, that's a very interesting question. What I think is going on is if you look at the gold market, there you see the same thing, right? It's a contango market. The future market is in contango, so but much less. So it's the gold prices 1 year from now are 1% higher, and the reason for that is that the cost of storing and insuring gold is about 1%. So that market is sort of in balance. So you could buy it right now, gold spot, but you get it delivered, and then you have to store it and insure it, and then that will cost you 1%. Or you can buy it for delivery next year, and then of course you don't have those costs. So that's sort of how it should be. And with Bitcoin, I think there's a very natural meeting of the minds, if you will, of two parties. And one, that's the very bullish Bitcoiners that want to play with leverage, that want to go 3x, 10x, even 100x, which of course is crazy. But that's the fastest way to get wrecked. Even 10x is leverage is not very wise. But big markets and a lot of people doing that. So there's a whole bunch of people looking for leverage. And then, of course, there's on the other side, people that provide that leverage opportunity by taking the cash and carry side of that trade. So they're happy with the 20% risk-free, and they give up the upside, right? Even if Bitcoin does the 200% average return, you're missing 180%. But of course, if it goes down 80%, you also miss that. So there's a risk averse group of investors, and I call those the traditional investors. Maybe I know there's a lot of hedge funds doing this, and then on the other side of that same trade is the leverage long, very bullish Bitcoin investors, and those are that's a very natural market, and as long as they those two groups keep growing and keep going at it at the way they're doing right now, that 20% margin in between will stay there, and Bitcoin will go up. It will have room to go up, in my view.
Well, so that it seems so strange to me, right? Because if you're a corporation and you can float a bond for 1 or 2%. For say $100 million, and then you do this cash and carry trade, and then you pay out the 1%, you make 19%. That seems like a no-brainer. Why isn't that happening? Like, what? It seems like such a straightforward trade. I feel like we're missing something here about like how these markets work, or there's some leak somewhere, or hidden risk, or something.
Well, that's a sound thought that maybe we're missing something. But I'm doing this myself, and it works. So and you could also say, why is nobody doing this? Which is what I've been saying as well. But on the other hand, if you look at the market and the open interest, the number of contracts that are out there, it's growing every day, and it's about it's almost 20 billion right now. Only the futures markets. So. It is growing. I guess more and more people are actually finding this neat trick, arbitrage, and doing it. So the question then becomes, how long will it stay? I think it will. It will stay very long, by the way. But Yeah.
But that's like a free 20% that anyone could get if they just do the cash and carry. And it's not like, I mean, contango happens with oil all the time, right? Like where you have to actually store the freaking barrels of oil for an entire year before you make it, and you have to factor in the cost of storing the oil safely and legally and in a regulated way and stuff like that.
Yeah.
But with Bitcoin, there's no real storage cost. It's not a physical item. So
or Jimmy, what also could be the case is that investors perceive the storing cost as very high because coins get lost, and you have to do this very weird thing with the keys, and the keys can get lost, and maybe they're very afraid of that, and it's like the custody costs that are very high, and insurance costs, and they fear hackers, and maybe the risks are perceived very high. It could be that simple.
I mean, perhaps. So that's absolutely fascinating, and I wish we could talk more about it and figure out what's going on. But let's go back to Bitcoin, the asset, because I think what you described it as is it's sort of an asset that's outside of this central bank paradigm of zero risk, but also zero reward. It's a lot of risk and a lot of reward. And it seems right now that it's starting to entangle with a lot of stuff that's central bank managed. And when you mix those, you get something that's in between. It's not completely risk-free and completely like zero reward, but at the same time, it's also not, lots of risk and lots of reward. It's like somewhere in between. So, for example, if you buy MicroStrategy stock, you're somewhere in between because they have a lot of Bitcoin on their balance sheet. If you own their convertible note, well, it's also something in between because you don't actually have Bitcoin, but you get exposure to MicroStrategy's upside. And at the same time, like, they'll at least pay like 0.75%. So is Bitcoin like sort of changing traditional financial, assets or, products to like actually add a little bit more juice to all of that? What's going on here?
Yeah, I think that's correct. Although we have to keep in mind that Bitcoin is very small. So it's about, what is it, 800 billion right now market. So that's a large cap stock like Tesla. But it's not big in bond market terms or foreign exchange market terms, where those are measured in the tens or trillions. I think the global bond market is 100 trillion US dollar. So Bitcoin is very small. In that way, it cannot be of much importance in the traditional finance world at this time. But on the other hand, all the stuff that we talked about, the risk-return world, the central banks are going out of their way to kill risk and yield, and they're succeeding in that by just printing so much money that there is no risk and return, seemingly no risk and return anymore. But the world is not a riskless place, and that risk has to go somewhere. And I think that the way I look at it is most of that risk is sort of regrouping in the Bitcoin space and the return as well. It's like you get all the risk return that is deleted from the traditional markets by the money printer. That it sort of drips into Bitcoin in a concentrated way, and because all the markets are interconnected, from Bitcoin, it goes back to normal markets as well. And you named you mentioned the MicroStrategy example. That's very interesting because there you have a lot of Bitcoin exposure that you can just buy on the NASDAQ. And it is sort of a Bitcoin ETF, right? That's not allowed in the US as an ETF. But a company that has a lot of Bitcoin on its balance sheet, of course, has the same risk return profile. And so there the markets are interconnected, and I think we see more of that. You can almost predict what's going on. It's like risk and return is like water. You can kill it in one corner, and then it shows up in the other corner. And arbitrages can be short-lived in one area of the world, and then they pop up in another area of the world, or another asset. So they're constantly packaged and repackaged, but it never goes away. There is risk and there's return. And so I'm very glad that it popped up in the Bitcoin corner of the world where a lot of us have been looking and investing. So I think that will continue.
So, I mean, in a sense, what's happening in the financial world, at least with MicroStrategy, Tesla, and the convertible note and so on, is that you have this central bank world where there's zero risk and zero really return. You have the Bitcoin world where you have a lot of risk and a lot of return, and they're starting to commingle, and it's almost as if the central bank has no power over Bitcoin. So when you mix those, you get something that's like somewhere in between that that seemed pretty attractive to a lot of investors. For example, the convertible note was oversubscribed by like $150 million. Do you see more of that happening going forward in traditional finance? Are people going to demand more of this? Are companies going to float more convertible notes or something similar to give some exposure to Bitcoin or something like that? What do you see happening going forward?
Yes, I think it will go on. It is the same as in the beginning when you buy Bitcoin. I think every one of us has this same feeling. In the beginning, you don't know what it is. It's risky, but you find it interesting and you want to invest. So you don't bet the farm, but you just take out some money and, well, put your toe in the water. And then you see it double. And you think, hey, I should have done more. And then you do some more, and then it doubles again. And then, well, that's how you sort of get sucked into the Bitcoin, and you keep this feeling of never having enough Bitcoin. But that's the same, I guess, with the futures cash and carry strategy that we talked about. I think if you do it one time and you see, hey, I get this 20%, and there's no volatility. It's just nothing unexpected. All the cash flows are there daily as I expected, with no hiccups. Let's do it again, but with 10 million instead of 1 or 100 million or whatever. And the same with MicroStrategy. I think the note was about 700 billion that the loan that they took out, and it was against 0.75 basis point or 0.75%, 75 basis points interest. Well, I think that was a pretty sweet deal for them, because Bitcoin already doubled, I guess, since they did it. And I would be surprised if they were not talking about a next note, which would maybe be bigger than the 700 million. And of course, Michael Saylor, but me too, and all the other investors, they talk with their friends, and they talk about especially investors, they always talk about their returns and their portfolios. So if somebody says, well, I had a great year, I made 10% return. Well, right now he gets laughed at because a Bitcoiner will have 200%, the cash and carry trader will have 20%. And maybe Michael Saylor with his 700 million note has even more. So I think this is a self-sustaining cycle that just word of mouth grows and grows and grows.
All right. So question for you, and I'm pretty sure that like the listeners of the show will want to know this information. This cash and carry trade, which is essentially buying Bitcoin now and selling the future. Is this available to retail investors as a way to get 20%? Because that seems like something that a lot of people would just sign up for in an instant. If they can get 20% in a 12-month, I mean, this is essentially like a 12-month CD that you're getting 20% on. Like, is this something that they can do? Is that a trade that, like, what would be required for a retail investor to do the cash and carry trade?
Yeah, well, that's one of the reasons that I quit my job to just analyze and investigate the opportunities for retail investors a little bit more. Because frankly, I don't know. I know that for institutional parties, it's quite easy because you could go to the CME exchange in Chicago or New York Stock Exchange in New York. And but I guess the minimum there is 5 Bitcoin contracts for the futures. So that's currently
That's not a small amount. That's
no,
almost $250,000 already.
yeah, that's $250,000. So there will be a lot of people who can't do that. And so actually I don't really know if it's available at which exchanges at what rates and at what costs as well. So I know there is exchanges that because we haven't talked about the option market, but there you can do something similar. It's called covered call writing, and you can even get as much as 40% on an annualized basis, but with a little risk. And I know that particular option strategy is very well available for retail investors, and I think I think it's available as well for futures cash and carry. But I cannot recommend at the moment which exchange you would have to take or something, and that of course could be a little bit of a risk because the CME and the New York Stock Exchange, of course, are very large institutions that are very well known by traditional investors and that have excellent custodian services behind it. I think Fidelity does that, and also insurance up till a certain amount. I think up till 150 million, your trades are insured. So your average exchange in a small country will not offer those services, and of course you would take on some risk at that moment. So those are all things that I'd like to analyze and publish about, and also use myself. So I think it's a lot easier with the option markets, but there's other risks involved, of course, with volatility. But short answer, I think it is available, but I don't know exactly, and I don't know if it will be against the same favorable conditions as we institutional investors can do it.
All right. So you mentioned the covered call writing. Essentially, that would be buying Bitcoin and then selling a call in the future, I guess maybe at the same price or something like that, and getting the premium. The risk there is that Bitcoin goes down enough that the premium doesn't cover the loss on the underlying. Is that what it is?
Yeah. So future is the right to buy or sell and the obligation. So you have to sell or buy, and the option is just one leg. So there's the right to buy or sell, but not the obligation. So for example, a call option, if you buy a call option so you buy the right to buy Bitcoin at the current price, for example, and if it goes up, of course, that right is worth something because you can buy against the lower price, the current price. But if it goes down, you're not going to exercise that right. So if you have a call option for 48,000, or what is the price right now, and the price goes to 40,000, then of course you buy for 40,000 and not so you don't exercise your call option right. So that has some specific advantages and disadvantages. But and of course, I should take a warning here. This derivative stuff with futures and options and swaps, etc., is quite complicated. You have to know what you're doing, and it's basically not something that retail investors should do. So maybe the best thing would be for a fund to sort of make this available for retail investors.
Yeah, I mean, it seems like a very easy hedge fund to set up. It's just okay, this is the strategy we're going to execute. We're gonna sell covered calls, and we're gonna do the cash and carry trade on the future, and that's all we're gonna do for the next year, and you either get the money back or you don't. But I mean, like the risk is here are the risks. Bitcoin crashes to this price. Like you'll know exactly all of the numbers basically, and then you could take a management fee, and even after the management fee, I imagine it'd be at least a 15% return.
Yeah. And Jamie, the call option market, it's crazy. It's you can have annual call option at the money call option premiums of 45%, right? So that's
wow.
You get that upfront, and you can keep it if the Bitcoin goes down. You can keep your Bitcoins too. And of course, you give some of the upside away, but you have capped your upside at 40 or 45%, which is very
that's
yummy.
Not terrible, to be honest.
Exactly.
I'm sure there are people listening in and saying, you know what, I might not do Bitcoin, but 40%, I could get on board with that, especially if it's a fairly low risk. So let's get into something else that's sort of a consequence of all of this that we're talking about, which is this futures cash and carry trade and the covered call option trade. Both of them require you to lock up your Bitcoin because you basically have to. If you're doing cash and carry, you have to hold for at least a year before it goes back into the market. With a covered call, you have to you have to hold the underlying up until the option expires. So, like with both, that might cause a lot of people, a lot of Bitcoins to be locked up. This is a sort of secondary effect, but I think you and Preston have been talking about this. Can you describe what that's going to do to the market?
Yeah, we have. Yeah, Preston and I, and also Adam Beck is very interested in those strategies as well. I think he even does them himself. And we were tweeting about it like 1 hour ago. But it's we're looking at it. We're experimenting with it, and I think it's right. Yeah, Preston is right because it was his idea. Like, hey, if I lock them up, everybody locks them up, and then there should be a growing army of locked up Bitcoins underlying these future and option markets. I think that's true. That's absolutely true. And in a way, the cash and carry traders and or investors and the covered call writers are holders of Bitcoin, at least for the time they have their contracts, and those markets are growing fast, right? It's the future market is 17 billion or 20 billion, something like that, open interest at the moment. So that would mean by proxy that about 17 or 20 billion Bitcoin is locked up at the moment in future markets around the world.
17 to $20 billion worth of Bitcoin, right? Not that.
Yeah.
Yeah.
Yeah, of course. Yeah. There's only 80.5 million. Yeah. Yeah.
Well, there has been sort of like a drawdown from exchanges recently. Do you think this might be part of the cash and carry trade or the covered call trade?
Yeah, could be. And that's where the on-chain analysis comes in. And it's very interesting because you can, of course, track all those cash flows, those Bitcoin flows, if you will. And I talked with Willy Woo and Preston about this lately. And it's you see some very interesting patterns on chain, and this coins getting off the exchanges could be two things. Actually, it could be large buyers like MicroStrategy and Tesla, etc., that just take their coins off the exchange, as everybody should do, right? I mean, it's not your keys, not your coins, and we have seen some very horrific accidents with exchanges getting hacked or accounts getting frozen by governments. Mt. Gox is one, but there's a lot more. I think, yeah. So especially if you're a big buyer and a long-term holder, you'd like to have your coins in own custody and keep the security at very high levels and keep them off the in deep cold storage, as they say. So it could be that, or it could be I don't know exactly what is counted under the exchanges umbrella, right? I don't know if futures and option markets, if derivatives markets are also counted in there. So it could also be if the CME and the New York Stock Exchanges are not in the exchange buckets, it could be that there is a flow of Bitcoins from the Krakens and the Coinbases and the Bitstamps of the world to those option markets and future markets. But to be honest, we're analyzing that at the moment. I don't know which of the two it is. But it is very intriguing. Either way, they're locked up, right? If they're in cold storage.
And either way, there's less supply, which means that the price will have some, because there's less supply and more locked up, that means that the price is likely to go up as well.
Yeah, well, that's one thing we can be 100% sure about. The shortage of Bitcoins is getting bigger and bigger every day. The shortage is real, believe me. If you look on-chain, there's just not enough Bitcoin. And yeah, that's I think what's driving the prices. But yeah, that's also what underlies the stock to flow model, of course. I think there will be an eternal shortage of Bitcoin.
Okay, well, so let's get to that, because I can't believe we've been talking for almost an hour and we haven't really even mentioned the stock to flow model until now. Can you tell our audience where you came up with this and why you think it's legitimate?
Yeah, not to go into too much detail, but as a traditional investor, you always have to have some kind of valuation model. You have valuation models for bonds, for equities, for derivatives, for everything. It's mostly cash flow based, of course, because that's easy. But for Bitcoin, there wasn't really anything. So yeah, one of the first things that I had to have for myself, at least, to do an investment in Bitcoin is some kind of model for evaluating this thing. And well, in the beginning, I didn't have very much, and of course there were some Metcalfe based models or time based models that over time the number of addresses grows and the value of the network then grows exponentially with that. But if I looked around at the time, when I looked around me and when I looked at myself, why do people buy Bitcoin? It's because of the 21 million. It's because it's scarce. And so I started looking for something to quantify scarcity. And I know the gold market, for example, has this same problem because there is no cash flow associated with gold as well. It's just buy and hold. So what is it worth? There is no valuation model for gold. But in the gold market and general commodities markets, they do have a number that quantifies scarcity, and it's the stock to flow measure. It measures how much gold, for example, there is above ground and how much gold there is produced every year. And you divide those two numbers. For gold, you get then 60. It means there's 60 years of production of gold above ground. And the higher that number, the higher the scarcity, if you will. So, I started measuring that for Bitcoin over time, but also measuring that for different markets like the gold market and the diamond market, the silver market, real estate market even. And if you plot that, so scarcity, stock to flow on one axis and the market value on the other axis, you get this straight line. And well, yeah, I was just stunned when I saw that the first time. I thought this can't be true, but yeah, I guess it is true. And if you run a more formal regression on it, then it confirms this feeling that there is a linear relationship between the logarithmic of stock to flow and the logarithmic of the market value, with very high R squared and very all the other statistics, the F statistic, T statistic, etc., are okay. And there's lots of statistical and econometrical debate going on, of course, about these models. But in the end, it's very simple. If that straight line is something, it's not a nonsense correlation that we're seeing, then Bitcoin should go in the direction of gold, because the stock to flow of Bitcoin now is about the same as gold, which means it has another 10x to go. And then it should go after real estate market, because the real estate market is even scarcer than gold. It's stock to flow 100 about. So it's a very simple model. You can make very complex discussions about the statistical properties of the model, but in the end, it's just the idea that scarcity and the 21 million is the reason that people buy this stuff and use it as store of value. And I think that's just from a causal point of view, just true. At least it was for me.
Yeah, and that's sort of the thing that we've been discussing, is that there is sort of like a shortage, and when you have a shortage of supply, that of course means that on the supply demand curve that we go towards a higher price and so on. So there have been some criticisms of the stock to flow model. For example, like, if you're measuring in dollars, then you get this straight line. But of course, central banks are printing lots and lots of money. So is there a better measure than dollars that maybe can be used instead to, maybe more instead of dollars, since, dollars are expanding particularly egregiously over the last year. So what do you say to that?
Yeah, I think. Well, first of all, the printing of dollars is affecting all the assets on the line, right? It's also affecting gold and also real estate, because everybody is buying real estate. But apart from that, I think the more pure way of looking at it would be to value things, for example, Bitcoin in gold. So. I just today put up a chart, by the way, where you measure Bitcoin in gold. And when you did that a couple of months ago, it was like 6 ounces of gold. And right now it's 23 ounces of gold already. So even if you take the dollar completely out of the equation, Bitcoin is growing and growing relative to gold. And I think all other assets, because the scarcity, of course, is moving up through the halvings, which is very particular thing for Bitcoin, and less so for gold, because the stock to flow of gold is sort of stable over the last 100 years. It was 60 plus or minus 10, and so was the buying power, by the way, of gold. So this is an area that certainly should be looked into more, and is part of future research. But measuring Bitcoin in gold terms is a very pure way of looking at it, and then you see the exact same relationship.
So there's a quantification of scarcity in a way that we're kind of able to see with stock to flow that we haven't really been able to measure in any other way. And that to me seems like the basis of this model and the other model that you made, the S2FX model. Can you describe for the audience what the difference between the S2F and S2FX models are?
Yes. So the first model that I made at the beginning of 2019 was the stock to flow model. The stock to flow model is a time series model. So I only looked at Bitcoin prices, monthly closing prices, and related them to the monthly stock to flow. And that sequence of stock to flows and Bitcoin prices, those time series, they made up the model, the regression analysis, the formula that was used in that model. And the stock to flow X model, what that did was remove the time series element from it. So what it did was compare Bitcoin with gold and silver and other assets. So that's why it's the cross asset, the stock to flow X model, if you will, and Bitcoin, yeah, it's a bit of a difficult asset. If you look at the last 10 years, it has a wide range of stock to flow, of course, from 1 to about 55, where it's right now. But you can see, if you plot that, you can see clusters of stock to flow after the halving, of course, and the values that are associated with those stock to flow clusters. So it might, in my view, it's better to look at Bitcoin as a asset that has gone through transformations from a proof of concept in the beginning to a collectible to a e-gold asset to a really financial asset that companies and banks and hedge funds are looking at right now. So that particular stock to flow value asset, you could look at Bitcoin in those clusters as different assets. So I identified 4 Bitcoin clusters and combined it with the other assets like gold, silver, real estate, and diamonds, and run a regression through that. And that's the stock to flow X model.
And predictions, of course, are seem kind of crazy when you publish these articles. But now that we're almost at 50,000, they don't seem so crazy anymore. What's the response been?
Yeah. It's, you know what's funny? The first article I wrote in March 2019, I had this prediction, and at the time the Bitcoin was between $3,000 and $4,000. And everybody was saying, "Oh, it will go down, and it will go to below $1,000." So when I came with the prediction of $55,000 at the time, it sounded so crazy, and then I even tweaked the parameters a little bit. Right, I rounded the parameters of the model to keep it a little bit lower, because otherwise it would have been 80,000-90,000 and I thought that would be, just too crazy. So, but right now, sitting at 40, what is it, 48.6? It sounds really low. And the stock to flow X model with a target of 288,000 as an average, mind you, as an average over the next couple of years. That sounds a lot more fitting to the current context of quantitative easing, low interest rates, and banks and hedge funds and companies just discovering this new asset.
And what would it be if it were priced in gold? How many ounces of gold is in both models if we measure it in gold instead of dollars?
Yeah, that's about 100. 100 ounces of gold for the next couple of years. So at current prices, that would be 180,000 something. If the price of gold stays stable, right? If the price of gold goes 50% up, it will be pretty close to that 288 number.
Wow. And how bitter do you think Peter Schiff will be if that ends up being the case?
I never know, either he is playing this so well and is buying like a madman while shouting that it's all nothing, and so he's either loading up heavily without telling us, or he has been stuck at the older generational crew. Let's not forget there is a whole bunch of older people that have not been raised with computers and mobile phones that are just a bit wary of things that are not physical, and you feel that with Peter Schiff as well when he touches his cufflinks and his the gold and talks about gold, and it feels good, it is so heavy. I just think he's not a programmer. He's not not so computer minded, and maybe not so open to this new digital and the power of encryption, for example.
Yeah, it makes sense. So, are you working on anything else that we should be anticipating? Because obviously, stock to flow and stock to flow cross asset have had a tremendous impact on this community. I'm curious if you have anything else in the works.
Yeah, there's lots of stuff in the works. So much actually that I had to quit my job. So I'll be 24/7 Bitcoin as of March 1st, so in 2 weeks. And I'm really, really looking forward to that. So my plan is to first take a little bit of a holiday, not run to all the things that are on my desk right now. Just take a bit off, breathe, and think about what we are going to do. And there's so many opportunities. But yeah, analysis, investing, looking at this derivatives play and plays, the futures, cash and carry, and the option writing strategies, that will be prime focus. And also on-chain analysis, the thing that Willie and I talked about lately. I'm really interested in all the online metrics. Stock to flow is one, but there's lots more. And I talk a lot with miners and investment funds, and I really, really like that. So I really want to spend the time analyzing, reading interesting stuff, and meeting interesting people. So very much looking forward to that.
Okay. Wow. That sounds really fun. Where can people find you, and how can they sort of support your work or read your work or whatever?
Yeah, you can find me on Twitter, PlanB at 100 trillion USD. That's my main channel. I do have a website. It's planbtc.com, and all the podcasts and articles are on there. So please reach out. My DMs are open, and if you have interesting ideas or stuff I need to know, please let me know.
Sounds good. Thanks for joining us. It was really enlightening. I'm going to predict right now this will probably be my most popular podcast I've ever released, but we'll see.
Thank you, Jimmy.
Thank you. Well, that wraps it up for this episode of Bitcoin Fixes This. PlanB can be found at 100 trillion USD on Twitter and planbtc.com. Until next time, fiat delenda est.